Investors looking for a sense of direction following the US election may have been left confused by the contradictory reaction of bonds and shares in US smaller companies. Mr. Trump's unexpected victory has sent shares in US small caps surging in value, with the Russell 2000 index rising 7.6% since last Wednesday. The apparent logic is that smaller US companies are more exposed to the domestic economy and so are thought to be better placed to benefit from any fiscal stimulus launched by the incoming president. The high weighting of healthcare and financial companies in the Russell has also helped, as investors bet that these sectors will be subject to less scrutiny under a Trump administration than a Clinton one. At the same time, high-yield debt, large chunks of which are issued by small-cap US companies, sold off after the vote as their investors turned their minds to a world of higher interest rates. The largest junk bond ETF, the $16 billion BlackRock iShares High Yield Fund, fell by over 2% after the vote before recovering some ground at the start of this week. In theory, one of these two signals should be wrong. Higher interest rates are likely to pose a problem for the more leveraged, smaller companies in the Russell Index, making their debt servicing costs higher and making these borrowings more difficult to refinance in the future. This in turn is bad for their share prices. Larger interest bills eat into earnings, and the elevated valuation that the Russell trades on would appear likely to be less attractive should rates rise. Credit quality, however, does not currently appear a concern. The number of high-yield corporate defaults continues to be low, falling on a trailing 12-month basis from October compared to September, according to S&P. Much of the distress continued to be in the energy sector, with the default rate dropping to just 2.4% once this sector was stripped out. As the initial sell-off in junk debt subsides, the market appears to be placing the onus right now on the shareholders to decide whether the optimism they have priced in is justified. If their faith begins to waver, then the Russell Index, trading at a lofty 40 times trailing earnings, looks to be vulnerable.